Good morning and welcome to the Invicta Holdings Limited final results presentation for the year ended 31 March 2024. Stephen Joffe, the CEO, is joined this morning by Nazli Raj Mohammed, the CFO. They will take you through the results presentation. You will have an opportunity to post your questions by using the question function on your screen. I will post your questions after the conclusion of the presentation to the panelists. I now hand you over to Stephen Joffe.
Welcome to you all and thank you for joining us for the presentation of the Invicta results for the year ended 31st March 2024. My name is Stephen Joffe, Chief Executive Officer of Invicta Holdings, and our CFO, Nazli Raj Mohammed, joins me in presenting our financial results. Executive Director Craig Barnard is also available to answer any questions. During this presentation, to the extent we analyze information or make forward-looking statements, please have regards to our disclaimer. Today's presentation will cover our group and segmental results for the 2024 financial year. We will also cover key developments, the prospects and strategies. Invicta distributes world-leading, earth-moving, industrial, automotive, and agricultural products, often exclusively, which are overlaid with a technical and service solution. We add value through our distribution chain, product availability, and by providing technical support. Technical support helps us prevent disintermediation and is a key part of our strategy to add value to our customers. Unfortunately, the conflicts in both Ukraine and the Middle East continue, which have contributed to the resultant worldwide inflation we are currently experiencing. Many central banks have maintained higher interest rates to curb this inflationary trend. In South Africa, we experienced continued load shedding and increased water supply disruptions, as well as severe flooding in the Western Cape in September 2023. We incurred upward pressure in supplier pricing, volatility in currencies, as well as supply chain challenges, including shipping and logistics disruptions. Notwithstanding the challenging environment, we're extremely proud how our businesses performed during the year. The resilient character of our management teams and robust nature of our consumable parts businesses shone through. We continued to assess acquisition opportunities throughout the year, and in July 2023, we acquired IMEX Part. After year-end, on 1 April 2024, we also completed the acquisition of the nationwide bearing company in the UK. We also bought back shares during the year. Notable achievements for the year include sustainable operating profit before net finance income and foreign exchange impacts increased by 8% to 702 million rand. We increased sustainable headline earnings per share attributable to ordinary shareholders by 5% to 488 cents per share. Cash generated from operation increased by 28% to 818 million rand. We disposed of 5 properties that were regarded as non-core to the group's operations. We repurchased approximately 2% of our ordinary shares and 4% of our preference shares. Our net asset value per share increased 13% to 52.50 rand. Group financial overview. Consistent with the prior year, we report on 5 segments, and while K&N forms part of the RPE segment, we report separately on K&N due to its relative size and contribution. Our segments are RPE, K&N, RPI, RPA, and CE. Sustainable operating profit was 8% higher than the previous year. In determining sustainable operating profits, we have made the following adjustments. We have reversed the impairments of the capitalized research and development costs on the gasifier project, amounting to 20 million rand. We added back the loss on the termination of an interest rate swap instrument of 1.2 million rand. We deducted the profit made on the disposal of non-core properties of 5 million rand, and we added back the impairment of properties of 1.5 million rand. We reversed 3 million rand relating to the amortization of the purchase price allocation assets in KMP in the current year and 3 million rand in the prior year. In the prior year, we added back a reversal of an impairment relating to properties amounting to 5 million rand. Equity accounted earnings from Keenan investment increased year-on-year by 9%. However, due to the sustainability adjustments, the sustainable contribution to group results decreased by 16%. In determining our share of sustainable net contribution from the Keenan Group, we deducted the profit on the disposal of a non-core property in Shanghai of 31 million rand and added back the amortization of the purchase price allocation asset amounting to 14 million rand. In the prior year, we added back the amortization of the purchase price allocation asset amounting to 30 million rand, and we added back the loss on the disposal of 50% of our business in Indonesia, amounting to 12 million rand. We will discuss the performance of the Keenan Group further in the operational segment review later in the presentation. Group sustainable headline earnings increased 1%. In determining our sustainable headline earnings, we added back our share of the amortization of the purchase price allocation assets amounting to 17 million rand for both the Keenan Group and KMP. We also added back the loss on the termination of an interest rate swap instrument of 1 million rand. In the prior year, we added back 15 million rand relating to the amortization of the purchase price allocation assets and reversed 40 million rand, which was a deferred tax asset created in that year, relating to historical assessed losses that were previously not recognized under IFRS rules. Please note that on a per-share basis, the group's sustainable headline earnings were up 5% year-on-year due to the share buybacks undertaken during the year. Please have a look at our key indicators. Where appropriate, they have been adjusted for once-off items to present sustainable earnings. Operating profit was 8% higher than last year. Further, share buybacks contributed to our sustainable headline earnings per share increasing by 5% to 4.88 rand per share. Our net asset value per share was 52.50 rand, which was 13% higher than the prior year. No adjustment has been made to the net asset value per share calculation. I now hand over to Nazli.
Revenue was 7% higher than last year. After normalizing the results for the IMAX acquisition, the base revenue grew by 4.2%. We will speak more on revenue in the operational segment review later in the presentation. The gross profit percentage was 33%. This was a major focus, and the management teams have worked hard on protecting our margin throughout the year. We remained focused on overheads during the year. Excluding the cost from IMAX and the impairment of the gasifier intangible asset in order to compare on a like-for-like basis, we saw an increase in our overhead base of 6.7% year-on-year. Given the rising costs of logistics and the depreciation in the rand, this has been an outstanding achievement, and I congratulate the various teams on managing their costs so well. We have already reviewed operating profit. We experienced massive currency volatility throughout our group. The rand dollar weakened year-on-year from 17.72 to 18.96, measured at our year end. The impact on our group for this reporting period was a net foreign exchange gain of 31 million rands. In South Africa, we hedge our foreign creditors as a matter of policy. Net finance cost increased by 41 million rands. From February 2022, we saw the prime lending rate skyrocket from 7.5% to the current rate of 11.75%. In 2024, we experienced this rate for almost the entire year, as it arrived at this peak in May 2023. Additionally, this cost also does not reflect the impact of the preference share, which is linked to prime. We will discuss this in more detail later in the presentation. In the prior year, the move in the effective tax rate to 19% was primarily because of recognizing a deferred tax asset in Invicta Treasury, which was not previously recognizable under IFRS rules. As our preference shares pay a dividend at a rate of 108% of prime, the cost of funding our preference share payments increased in line with the increases in the prime rate of interest. Please note the 142 million rand gain on translation of our foreign operations. This reflects the depreciation in the rand over the year. Property, plant and equipment increased by 121 million rands. Most of the increase is attributable to assets acquired as part of the IMAX acquisition and additions to the vehicle fleet in the RPI businesses. The properties held for sale last year were sold. A further property was held for sale and sold subsequent to year-end. If we aggregate our capital investments across our businesses and compare that to our depreciation charge for the year, we see that we have spent 11.8 million rand on expansionary capital expenditure across our businesses this year. Included in our investment in associates in the prior year was our 45 million rand investment in BMG China, which was restructured in the current year and has been reclassified as a subsidiary of the group. Investment in joint ventures is our 48.8% investment in Keenan, as well as our 50% share in the KMP Far East business in Singapore. The increase from last year is primarily related to that of Keenan and is made up of 167 million rands of equity accounted earnings and 92 million rands due to foreign currency translation. The dividend declared of 102 million rand has reduced the carrying value of this investment. Goodwill has increased by 23 million rands. 4 million rand is a foreign exchange adjustment related to KMP, and the balance arises from the acquisitions made in the year. Finance lease receivables, including the current portion, increased from 74 million rands to 214 million rands. As risk profiles change, management has seen an opportunity in extending credit to customers in the capital equipment segment, hence the increase. There is a corresponding increase in the finance lease liability as we take out back-to-back financing with our banking partners. Loans receivable decreased from 186 million rands to 98 million rands. The $3 million receivable outstanding from CNH as part of the deferred proceeds from the sale of our agricultural business was paid at the end of January. Consequently, our non-compete in the agricultural sector has lapsed and we are free to evaluate opportunities in the sector. We remain focused on managing our working capital. Part of our strategic decision-making in this regard resulted in inventories net of provisions increasing by 124 million rands. In RPE, we had a decrease of 29 million rands year-on-year in our net inventories. This was down to a rationalization of our stock lines as the teams worked hard to ensure we are holding the correct stock across the business. RPI managed their working capital well during the year, and an effort was put into the selling of aged inventory, hence the reduction in their stock holding. The movement in the RPA segment is primarily attributable to currency volatilities and the addition of the IMAX business in the year. Due to the logistical challenges and backlogs at our suppliers' factories, we experienced an increase in inventories in our CE segment by 178 million rands as large quantities of stock arrived simultaneously. Most of the additional stock will be disposed of in the first 6 months of the new year. Our management teams continue to focus on the number of months stock held. We are still experiencing volatility in both currencies and logistic costs, as well as inflation in the cost of our basket of products. Our continued focus on ordering the correct inventory and selling aged inventory has helped to keep our inventory value at an appropriate level. Trade and other receivables decreased by 24 million rands. We continue to see tight levels of debtor insurance across all the businesses in the group and focus on giving appropriate credit and collecting our receivables. Please note our cash on hand of 999 million rands. During the period, 2.2 million ordinary shares and 267,000 preference shares were repurchased for a total of 88 million rands and subsequently cancelled. By year-end, all treasury shares had been cancelled. Our interest-bearing liabilities include borrowings and lease liabilities, which together amounted to 1.4 billion rands, of which 1.2 billion rand is non-current and 189 million rand is current. With our cash on hand of 999 million rands and our overdraft of 94 million rands, we have net cash on hand of 905 million rands. Our net interest-bearing debt is thus 483 million rands. The equivalent number in March 2023 was 634 million rands. This 151 million rand reduction in net debt is after the 182 million rand dividend paid to shareholders and after the 88 million rand used to buy back shares. Please note that the 483 million rands excludes the IFRS 16 liabilities of 271 million rands. Including IFRS 16, net interest-bearing debt for the period decreased by 183 million rands. Our net interest-bearing debt to equity remains a healthy 13%. Please see a summary of our covenants reflecting our compliance on the 31st of March 2024. We are pleased to have generated 818 million rands cash from our operations. This is after investing 150 million rands in working capital. We paid 182 million rands in dividends to shareholders. In the year, we received $3 million from CNH as part of the deferred proceeds on the sale of our agricultural business, and we purchased the IMAX business in the UK and 50% of the KMP Far East business in Singapore. Dividends received are primarily from Keen An. Please note the 61 million rand used to buy back ordinary shares and the 27 million rand used to buy back preference shares. I now hand you back to Stephen.
Thank you, Neslie. Operational segment review. Replacement parts, service and solutions, earth-moving equipment, RPE. This segment includes Keen An, ESP, KMP, amongst others. We will first report on the other parts businesses, and Keen An will be reported on separately. The sustainable operating profit of the segment was up 33% year on year, and we worked hard on bringing the working capital, specifically in the United States, to the appropriate levels. This contributed towards a commendable increase in our return on net operating assets to 30%. We are working on obtaining bonded warehouse status for our warehouse in KMP in the United States, which will support strong growth in the region and create a hub for us to leverage off. Please see how we determine sustainable profits for the purposes of determining our returns. Earthmoving, which includes mining and construction, is 83% of our revenue, and 17% is derived from agricultural and forestry users. All our revenue in this segment is from parts. We are experiencing good demand for our parts in all the markets we service. We are closely evaluating our inventory lines to ensure that we're always holding the correct stock to ensure that we can take advantage of growth opportunities as well as remaining able to meet our customers' requirements. Our bond store in the United States are expected to come online in the first half of 2025, enabling us to serve Central and South America, with plans to open further distribution across the United States. Invicta owns 48.8% of the K&N Group. Notwithstanding this classification, we chose to continue presenting K&N as a segment in this presentation due to its relative size and contribution to the group. These results reflect the full K&N financial position and not the Invicta ownership interest. These results are presented in Singapore dollars. Revenue was 50% lower than last year, primarily driven by tempered demand for undercarriage components in the United States market. Operating profits decreased to $26 million. In considering the tough operating environment, all businesses performed in line with the operational environment. Net operating assets, which includes net cash of $51 million, increased to $203 million, and our return on net operating assets was 12.8%. Under the circumstances, we were satisfied with the K&N performance. We have seen tough trading conditions across Southeast Asia, and we expect these conditions to persist in the current financial period. Please see how we determine sustainable profits. The adjustments in the K&N Group included the reversal of a profit on the disposal of premises in Shanghai, which amounted to $4.6 million. The biggest portion of our revenue is to general traders who then on-sell our products. Heavy machinery parts account for 81% of our revenue, and automotive parts account for the balance of 19%. The distribution business in the United States continues to provide a meaningful contribution to the sales mix, contributing 24% of revenue. Orders on the factory were lower during the year, and the trading environment in the United States market has remained persistently subdued. However, we continue expanding our product range produced in our factories and attempting to sell these products in the American market. We have made good progress to increase our return on operating assets, including disposal of certain properties that are not core to the operations of the K&N Group. We remain focused on restructuring our business across Southeast Asia in line with the subdued activity in the market. We believe that the tempered demand from the market is in line with the high interest rate environment that persists. Replacement Parts, Services and Solutions Industrial consists of 5 businesses, the primary business being BMG. Revenue for RPI was 2% higher than last year. Sustainable operating profit was 2% higher than the previous year. Part of this increase is because of improved gross profits and a well-controlled overhead base. Net operating assets increased $54 million, primarily due to devaluation of the rand. Our return on assets in RPI decreased slightly from 17.2 to 17.1%. The industrial sector has remained challenging throughout the entire year as the business sector weathers the deindustrialization drive in South Africa, as well as the continued impact of load shedding on both customers and suppliers. With the run-up to the election, we also experienced caution amongst customers, with uncertainty reigning over the outcome. Please see how we determine sustainable profits for the purpose of determining our returns. The adjustment made to the operating profit was the impairment made to the gasifier project of 20 million rand. We serve a diverse range of customers, and the teams have done well this year to continue to diversify the markets we serve. Consumables amounted to 57% of revenue, and engineering, which includes value added to products, amounted to 43%. Our businesses in Africa make up about 21% of the segment. We are seeing good opportunities in Africa. Maintaining our traditional margins and strong working capital management will continue to be an area of focus this year. Replacement parts, services, solutions, Auto Agri, includes our automotive and our agricultural businesses located in Poland, the UK and South Africa. Revenue for the RPA segment was 34% higher than last year, with most of their growth coming from the IMAX acquisition in the UK. RPA's sustainable operating profit was 19% lower than the previous year. In the automotive space, historically in South Africa, we have always represented a basket of premium brands and products in the market. With external pressures forcing customers to buy downwards, we looked to widen our product offerings by introducing more affordable ranges to meet customers' requirements. Net assets increased by 160 million rand, predominantly because of the acquisition. Our return on net operating assets has decreased from 33% to 18%. Please see how we determine sustainable operating profits for the purpose of determining our returns. Automotive and transport are the biggest industries we serve in RPA, with agriculture also an important sector where we are seeing good growth prospects. Consumables amounted to 98% of revenue, and engineering, which includes value added to products, amounted to the remaining 2%. Our businesses in South Africa make up about 40% of the segment. Our businesses in Europe and the UK make up the balance. We are working hard on improving IMAX with the introduction of car and agricultural products. We are expecting further progress in the current year. We continue to experience good growth in our agricultural brand, AgriParts Global, across all the regions where the brand is represented. In our strategy of geographical diversification, we are assessing the viability of opening additional branches on the European continent to distribute our product to a wider customer base. Capital Equipment CE. Our CE segment consists of 4 businesses, 2 being earth moving, construction and mining related, and 2 material handling businesses. Revenue for CE saw strong growth year on year at 13%. Sustainable operating profit was 32% higher than the prior year. The team did well to achieve a 26% return on net operating assets. Please see how we determine sustainable profits for the purpose of determining our returns. Earth moving, which includes construction and mining, accounted for 80% of revenue, and material handling 20%. Year on year, we have seen growth in the number of machine sales in the market we service, with equipment sales representing over 2/3 of sales for the CE segment in the year. As customers extend the life of their equipment, our parts business continued to do well. Good mining activities continued this year, with good demand for larger capital equipment. We are hopeful that with the elections behind us, there will be more certainty in the market that will drive growth in South Africa to further assist our construction-facing businesses. Key developments and transactions. During the year, the group purchased 2.2 million ordinary shares for 61 million rand and 267,000 preference shares for 27 million rand on the open market. At the end of the year, all shares held in treasury were cancelled. In July, we purchased the IMAX business, which forms part of our RPA segment. IMAX is based in Birmingham in the UK and operates in the aftermarket of the automotive industry. We are focusing on transforming this business to distribute our agricultural parts as well as our automotive components. We are hopeful that we will see the desired return in the business in the next year. In the year, we restructured our BMG China operations, streamlining their service offered to the rest of the group. In the year, we purchased most of the shares in this operation. BMG China is now a subsidiary. After the financial year end, the group elected to exercise the group's right to redeem all the outstanding preference shares. The details of the redemption can be found in the SENS announcement dated 13 June. Dividends on the preference shares will continue to accrue to preference shareholders up until the date of the redemption, which is anticipated to be on the 8th of July 2024. The redemption will be funded from available resources. We believe that the redemption of the preference shares will further streamline the group's capital structure and capture savings on the funding costs for ordinary shareholders. In noting this graph of our group's capital structure, we have successfully right-sized the net debt of the group. The cost of the preference share to the group significantly impacts returns to ordinary shareholders with the rate linked to prime, and thus we believe removing the preference share from the capital structure is the next further unlock for shareholder returns. During April, we restructured our KMP operations of the RPA segment by moving it into the Keenan Group. The rationale for this is to ensure that we and our partners in the Keenan investment remain aligned in our interests within the industry. With the proceeds from this transaction, we have settled offshore debt to ensure that we remain disciplined in our use of capital. On 1 April, we acquired Nationwide Bearing Company Limited. NWB is a UK-based supplier of consumable parts to the earth-moving and agricultural machinery aftermarkets. Their product offering includes items such as bearings, belts, bushers and seals. The NWB branded products are developed internally and manufactured via a network of outsourced partners across the world. The company is based in Doncaster in the United Kingdom. The NWB operation will form part of our RPE segment going forward. Lastly, management continue to evaluate potential acquisition opportunities, and we are well placed to take advantage of these opportunities as they arise. Prospects and strategies. We constantly review and restructure our existing businesses to ensure that they achieve the desired return. We have done well with regards to geographical and sectoral diversification, and we will continue working on this. Our objectives for the year include managing working capital and the balance sheet closely, optimizing operations and generating cash, managing the supply chain challenges, looking for appropriate acquisitions and new products. The war in Ukraine and the Middle East and the associated impacts on commodity and food prices will continue to be felt worldwide. Globally, inflation has resulted in borrowing costs remaining stubbornly high. thus continue to put high levels of pressure on the consumer. All indications are, however, that the next movement in interest rates by central bankers will be down. In South Africa, we're encouraged by the suspension of load shedding and recently by the election, and are hopeful that the Government of National Unity will implement policies and procedures which will allow industry to grow. The way forward for the group will require a disciplined capital allocation approach and the ability to move as the markets evolve. We believe that our businesses are well placed in their respective markets and we can meet the challenges that lie ahead. Our replacement parts businesses are resilient and generate good cash, with many of the sectors that they serve performing well. As a result of our relative financial strength, we can hold appropriate inventory to ensure that we continue to service our clients without stockouts and delay. Accordingly, we remain cautiously optimistic about the year ahead. We are extremely grateful that we've been able to deliver this performance. Thank you to our loyal suppliers, customers and advisors for your continued partnership with the group. Our incredible, experienced, diligent and dedicated team, from the factory floors to the boardrooms, we thank you all for your efforts this year. Lastly, we wish to thank our chairman and the non-executives for their guidance and advice.
Founded in the 1960s, Invicta drives a culture based on the principles of integrity, customer centricity, continuous improvement, and accountability. Invicta takes immense pride in partnering behind the scenes with its customers, providing robust service and product solutions that empower customers to be the very best in their respective markets. Invicta delivers above-market returns to our shareholders, while at the same time positively enhancing the societies we work in. Invicta has a global presence in over 13 countries, with manufacturing plants in China and distribution businesses in many parts of the world, including the United States of America. We significantly keep the wheels of industry turning in the global markets we operate in. Each of the business segments are respective stockists and specialists of leading branded industrial components and supporting value-added services. The group comprises 4 operational divisions. RPE supplies aftermarket replacement spare parts, ground engaging tools, and undercarriage parts for earth-moving equipment in Southern Africa. RPE is also an independent supplier of aftermarket heavy-duty diesel engine parts for industrial and agricultural machinery worldwide. RPA supplies imported and locally sourced automotive and agricultural aftermarket replacement parts and kits. In addition to 4 South African branches, European representation includes operations in the United Kingdom, Poland, and Ukraine. CE supplies and supports premium branded earth-moving and material handling equipment, as well as OEM and replacement parts, via a branch and distribution network throughout Southern Africa. RPI distributes a comprehensive range of engineering consumable products, supported by technical services and solutions across Africa. RPI's competitive edge stems from a broad footprint of over 70 branches and over 100 vendor-managed inventory consignment sites. The RPI segment has established an enviable reputation in a highly competitive sector by securing the distribution rights with leading manufacturers locally and globally. In addition to dependable technical support and value-added assembly, highly skilled teams offer the manufacture of customized systems to meet exact customer requirements. The Kian An Engineering Group is one of the largest independent distributors of heavy machinery parts and diesel engine components in Asia. An extensive range of parts is distributed globally for major OEM brands of excavators, bulldozers, wheel loaders, motor graders, trucks and trailers, as well as power generation sets and marine engines. All group operations align with Invicta's values as a socially responsible investor. We're not just simply a business, we're an integral part of the businesses, communities and societies we serve, with a strong commitment to addressing broader societal issues. We also care deeply about our world, and we strive to ensure our operations leave a sustainable environmental footprint. People are at the heart of our success. We empower, train and reward our employees, making sure they have the skills and motivation to excel. We also prioritize the securing of funding to fuel our growth. Building sustainable relationships with our shareholders and other stakeholders is important to us, and we recognize that our journey to success is a collective one. Essentially, Invicta's business is supporting, mentoring, managing and optimizing the performance of each division, with the clear vision of enhancing Invicta's position as a world-class supplier of replacement parts. Our strategy is guided by our unwavering commitment to excellence, ethical values, sustainability and the well-being of all those we impact. By supporting the 4 business segments, developing and entrenching long-standing partnerships with suppliers, being the customer's supplier of choice, and executing an internationally focused acquisition strategy in the relevant markets and appropriate jurisdictions. Together, we work towards greatness, making a difference and delivering outstanding returns for our shareholders.